The 2023 recession will make you rich. Recessions are a natural part of the economic cycle. Every few years, the economy will experience a period of contraction, which can lead to lower stock prices, higher unemployment, and a general sense of uncertainty. But for investors, recessions can also be a time of opportunity. When the market's down, stocks can be bought at a discount. And if you choose the right investments, you can potentially see huge returns when the market bounces back. One strategy for investing during a recession is to focus on companies that are financially stable, with strong balance sheets and steady cash flow. These companies are more likely to survive an economic downturn and can provide a steady source of returns even when the market's down. Some examples of such companies are consumer staples, healthcare, and utilities. These sectors tend to be less affected by the broader economic conditions and can provide more stable returns. Another strategy is to look for companies that are undervalued by the market. These are companies that have strong fundamentals, but whose stock prices have been affected by the broader economic conditions. By buying these stocks at a discount, you could potentially see large returns when the market improves. You can use financial metrics such as price to earnings, or PE ratio, price to book, or PB ratio, and dividend yield to identify such undervalued stocks. It's also important to diversify your portfolio during a recession. By spreading your investments across different sectors and asset classes, you can reduce your overall risk and ensure that your portfolio is not too heavily impacted by any one economic event. For example, you can consider investing in bonds, real estate, or even gold, which can act as a hedge against market volatility. Another important thing to consider during a recession is to have a long-term investment horizon. While it's possible to make large returns during a recession, it's also possible to lose money if you make the wrong investments. During a recession, the market will be volatile, and it's important to have the patience and discipline to stay invested for the long term. Another way to invest during a recession is to look for companies that are considered to be defensive stocks. These are companies that provide essential goods or services and are less affected by economic downturns. Examples of defensive stocks include food and beverage companies like Nestle and Unilever, pharmaceutical companies like GlaxoSmithKline and Novartis, telecom companies like AT&T and Verizon. It's also important to keep an eye on government policies and stimulus measures during a recession. Government actions such as interest rate cuts or increased spending can have a significant impact on the economy and the stock market. When investing during a recession, it's also important to be aware of the potential risks. One risk is the possibility of the recession turning into a depression, which can have a severe impact on the economy and the stock market. It's important to have a well-diversified portfolio and not to invest too much of your portfolio in any one sector or company. Now, let's consider an important financial metric: the yield curve. The yield curve is a graph that shows the relationship between the interest rates of bonds with different maturities. Typically, bonds with longer maturities have higher interest rates than bonds with shorter maturities. This relationship is, in some cases, the yield curve can become inverted, meaning that the interest rates of bonds with shorter maturities are higher than the interest rates of bonds with longer maturities. This scenario is considered to be a leading indicator of a recession. The reason for this is that it suggests that investors are more worried about the short-term economic outlook than the long-term outlook. When investors are worried about the short term, they tend to invest in bonds with shorter maturities, which results in higher interest rates for those bonds. This causes the yield curve to invert. It's important to note that an inverted yield curve doesn't always mean a recession will happen, but it has been a reliable indicator in the past. But it's also important to consider other economic indicators, such as GDP, unemployment rate, and consumer confidence, to get a more complete picture of the economic outlook. Recessions can be a difficult time for the economy, but they can also be a time of opportunity for investors. By focusing on financially stable companies, undervalued stocks, diversifying your portfolio, and having a long-term investment horizon, you can potentially see large returns even during an economic downturn. Thanks for watching, and if you enjoyed the video, please like and subscribe.